Our channel is built for the founders who want to go from growing their company to raising capital and to acquisition. We share a lot of amazing insights from the venture community. If you're interested in them, click that subscribe button below. Just last week, we had a conference that's called M&A 2020, where we had numerous speakers speaking about exit strategies and current environment. And today, one of the speakers, Serge from Corum Group, will be sharing his experience around M&A. Prior to this day, Serge managed 2 exits and 9 acquisitions from a sales side. Also, as Corum Group, they managed more than 350 transactions among tech companies. And today, Serge will give us latest updates on how the market is changing in terms of acquisition prior to crisis. Should you sell now or should you wait later? And how to prepare your company to the acquisition. Interested to learn more? Click that subscribe button below and let's go.
Very good. Well, quick some background. Vice President of Tech M&A at Corum Group. 3 years tech exec with 2 exits as well as 9 buy-side transactions prior to joining Corum. I am based here in Southern California, and I would say my focus is only on software companies, but would definitely narrow focus on healthcare, clinical diagnostics, as well as on CAD and engineering software. Let's talk a little bit about selling your company and what that means in times like this. In general, the numbers that we see for tech companies is that actually only about 1 in 4 companies get what we would call an optimal exit, meaning a good valuation, a good structure. About 1 in 4 will normally get a suboptimal exit, and unfortunately about half of the companies will actually never transact. And this is kind of where a situation also where we're in right now, as the crisis deepens and worsens, is that you're going to see more and more fire sales as well as emergency exits. And I want to talk a little bit about that. So in general, when you're considering selling your company, there's going to be different motivations for different CEOs. Of course, money is a big driver. If you have an opportunity to cash out some liquidity and go do something else or enjoy life a little bit, that's a great thing to have. But you may be looking at selling your company as a means to grow, find a partner with a bigger footprint. With all CEOs, succession, of course, a big driver, age, sickness, death, C-level burnout. We see a lot of that as well. I mean, if you've been working 70, 80-hour weeks for a couple of years, sometimes that is an impact on health and your overall life. So, and of course, serial entrepreneurs that want to sell their company because they have a new idea and want to start a new venture. Conflict is a big driver as well. You may have started your company with a buddy from high school or from college, and 2 years into your venture, realizing that you can't really work together. So you're at there's a conflict between yourselves. It could be with family. It could be with your board and your investor. So those are also, I would say, the normal motivators for somebody to sell their company. The big one, of course, that is topical right now is the fact that a lot of startups and early growth stage companies may just be underfunded to bridge a recession. And we'll talk a little bit more about that, but that's definitely a driver now to consider selling your company. So why sell now? Well, from past, I would say historical experience, having gone through a couple of recessions now in the tech space, and having some historical perspective, if you look at the year 2000 and the year 2008, where we had major recessions, it actually took quite a bit longer. It actually took 4 years as well as 2 years for the market actually to hit rock bottom. So what we're seeing now is already a pressure on valuations. I mean, where we're at today, we're seeing anywhere between 15 and 20% pressure on valuation. But the big difference with previous recessions is, of course, is that we're expecting that the slide will be much faster and could manifest itself in less than 12 to 18 months. But the big difference with the two previous recessions was that in the two previous recessions, we had economic fundamentals that were flawed. But here we basically rolled into this COVID-19 crisis with a very healthy economy and with a lot of both private equity and strategics sitting on a lot of dry powder, as we would call it, or cash reserves. And that money is still, in many cases, looking for good opportunities. The concern, of course, is that over time, as we're already starting to hear some of the companies reporting their numbers, that there is going to be increased pressure on the market, and especially longer term, 18 to 24 months from now, if you had some cash reserves from having done an A round or a B round, and you said, okay, I can probably last through the end of 2021 or 2022, you really have to ask yourself, will you have enough reserves to last maybe 5 years or 7 years, right? Because that's really what we expect it will take for the market to pretty much, if at all, regain the valuations that we've seen up to even last February. So our advice to you is basically to sell your company while it is still healthy and very attractive to buyers. So the clock, of course, is ticking. If you look at how this progresses, pre-crisis, we had record high valuations. There was four, and still is, that about $4 trillion in capital to spend. In terms of the transactions, we saw seller preferred structures because there were many parties that were vying for companies' attention and were interested in buying. As time goes by, we will still see capital that needs to be deployed, but it will be priced for risk, and the valuations will definitely correct, and there's going to be downward pressure as months go by. The worst situation, of course, is for companies say, oh, we're going to hunker down and ride this one out. Well, unfortunately, in many cases, a couple of months from now, be that 18 or 24 months, they may face a fire sale. If they are able to transact, more than likely, we're going to see more buyer preferred structures that will have much higher earnouts, that will have bigger conditions, and I would say far less a cash component as time goes by. So here's how this progresses. Of course, up to a couple of weeks ago, we were seeing mostly all cash deals, but as time goes by and we move more and more into a buyer's market, we're going to see more earnouts, we're going to see more acqui-hires, we're going to see assumption of debt, and we're going to see less and less just pure cash deals. Now, when I talk about which companies are still very attractive, so I'm just going to highlight. So here are the top 10 disruptive technology trends that we have been tracking for the year. Accenture led the pack with 27 transactions, followed by, I would say, Microsoft, J2, Dentsu, Amazon, that each did anywhere between 10 and 12 transactions. Now, for a startup or for an early growth stage company, you may think, okay, well, I'm not going to be attractive to a private equity firm. And so what's important here is that you recognize that you may still be a small company that is only doing $1 million or $1.5 million or $1 million in revenue, but you may actually be an attractive target to one of these PEs if you fit into, I would say, a particular strategic imperative of some of their portfolio companies, or if you fit in one of those top 10 disruptive trends. Of course, when you are looking to sell your company, you're the seller. On the other side of the table will be the buyer. And of course, as you try to transact, as you negotiate, you're going to negotiate not only on price, which is the first thing you're going to look at when you get an IOI or an LOI, but we'll submit to you the structure, liabilities, your taxes, non-competes, employment agreements, that you really have to look at this holistically. And that's one of the things that we cover extensively in our selling up, selling out seminars that are free to CEOs who want to participate. They're basically 4-hour boot camps. Now we're doing all online. Really, and especially, there's something to remember. Of course, as investment bankers, we do all that negotiating on your behalf because these things can get a little antagonistic at times, right? And sometimes we also lose sight that if your company gets acquired by, say, a bigger strategic, is that many times you're negotiating with your future boss. So you want to make sure that they are left a good impression and that you can start the post-acquisition with this new company with a good or at least a good footing with a good relationship. The M&A process, of course, has got a whole lot tougher, especially when we're dealing with bigger strategics that are public companies. They, of course, have a whole lot more scrutiny. The due diligence, regulatory, and compliance requires a whole lot more work. And there's a lot more work involved than people really realize, right? It's also a very crowded area. Most of the strategics and private equity representatives that we deal with will review anywhere between 800 to 1,200 deals a year. So it really comes down to making sure that you have a really compelling story that you can present to them and generate some interest in your company. I wanted to close it with kind of one other question that I was asked to talk a little bit about. So going the M&A round versus raising money. I know some of my colleagues on this panel here will talk a little bit about raising money in times like this, and we'll give you, for example, VC perspective. But from an M&A point of view, we are definitely saying, okay, don't look at just doing a raise as your only vehicle to get access to capital, right? I don't need to tell you, raising money is very difficult. It's time consuming. I've done it a couple of times, up to $17 million. You're sitting on an endless treadmill where you're going for one raise after another. And sometimes I would say the biggest issue is that you may end up with investors that may not truly understand and appreciate business. And this is key here, right? Especially when we're dealing with tech. We're also dealing with kind of pre-agreed ratio where you'll say, okay, well, we're doing a raise of $5 million with valuation of 20, but that's a fixed ratio. And of course, if you go in the M&A route, we're always saying that the market will dictate what your value is, and by creating an auction environment, you can basically garner a multiple that could be significantly higher than going the I would say funding route. I mean, you could say, okay, our PEG is 4 times revenue, but through the M&A process, you could quickly see that you'll get at 7, 8, 10 times revenue. But the key point here, though, is that the point for a funding round is that it brings capital, brings money into your company, but it doesn't necessarily create liquidity for the founders and for the shareholders. And that is a key differentiator, especially in time like this. If you want to take some money off the table, definitely recommend that you consider going the M&A route. You can do a full sale of the company, but you could also do a majority recap where you retain 5, 10, 15% of the company and potentially get what we call a second bite from the apple. And not to be ignored is that selling your company can also be a great career opportunity. Frequently, we sell companies to larger strategics where the CEO assumes a senior VP or a senior director role within the company and actually takes a more important role within the buying company. I was part of a scenario like that where the board basically within weeks shuffled the deck, and where we as on board as part of a smaller company then now became the entire management team of the whole bigger entity post-acquisition.